Welcome to this Killick Explains video. This week I want to take on, I suppose, an obvious question which has attracted some media attention and some blogging attention recently, and that is, what sort of return should I expect to get from investing in shares? Quite fundamental and also quite a difficult question to answer off the bat. Now, the reason I'm tackling this is because of the results of a recent survey from Natixis investment managers, where they asked the question to a series of retail investors and professional investors. And they did quite a big survey. I want to just highlight a few of the results. They asked, what return are you looking for in the future in real terms, that's inflation adjusted or after inflation, from shares? Now, retail investors came in with the following answers. US investors, believe it or not, expect a return of around 17%. More about that in a moment. UK investors, slightly more cautious, but nonetheless expecting a return of around 14%, annually that is. And German investors, more cautious still, they came in, according to the survey, at just under 11%. Now that was retail investors. So what about the professionals? Well, as a group, they were much more sanguine, I suppose you could say, and we'll talk about some of these differences in a moment. US professional investors reckoned around 6.7% annually after inflation is realistic. UK professional investors 4.6%, and German professional investors just below 5%. Now, what explains those differences and what conclusions can we draw? Well, naturally enough, professional investors tend to have been in the market longer. That's not to say all of them are more successful, but they do have a more sanguine view of what's likely to happen to shares in the future. Now, why is that? Well, partly because they use the past as some sort of guide. And depending on who you ask, the long-term real return from the US stock market, the S&P 500, is somewhere around the 8 to 10% mark. That's inflation adjusted. And in the UK, if you were to look at something like the Barclays Equity Gilt Study or the SFB Yearbook, as they're called, you would find it somewhere just north of 5%. So clearly, retail investors in particular, with their expectation of 17 in the US and 14 in the UK, are pretty optimistic, pretty bullish. And it takes quite a lot of optimism and confidence to believe those numbers. After all, the US stock market has put in something like a 17% nominal pre-inflation return over the last 5 years, and that is with an incredible amount of central bank liquidity being pushed into the market. So the idea that the US market could return 17% after inflation is a little optimistic. Now you might think, so what? Some people are optimists, some people are realists, some people are pessimists, but it does actually matter, and I'll explain why. First of all, investors need to be realistic when they set expectations. Warren Buffett's long-term investing partner, Charlie Munger, once said the secret to a successful life is low expectations, but certainly realistic expectations. If you go into stock market investing right now believing that 17% after inflation is achievable, you're almost certain to be disappointed at some point in possibly the not too distant future, given that the UK long-term average over a 50-year time span, according to the likes of Barclays with their influential study, is more like 5.5. Secondly, it's really important people understand risk. The stock market has looked since the financial crisis of 2007 and 8 like something of a one-way bet, with a few blips, including a monster one last spring as the pandemic took hold. But actually, over the long term, stock returns abound to align with their long-term average. The law of mean reversion suggests that after a few years of above average returns, you're bound to get a few years of subpar returns. Doesn't necessarily mean you'll lose money, but it does mean you need to be realistic and understand risk. And you also need to be careful of not anchoring. It's one of the mental biases we're hardwired with as humans, not very useful as investors, what we do is we tend to hang on to historic information even when it's no longer relevant. So people are tending to look back at the last few years, see the stock market turning in some quite spectacular numbers, and are assuming that will continue. But as Mark Twain put it, history doesn't repeat itself. It may rhyme, but it doesn't repeat itself. And if you want other examples, I know people who anchor to the price they paid for a stock and won't sell until it gets back up to that price if it dips in the interim. That's not logical either. And I was somebody who ran scared of property in the mid-1990s, going back a bit, simply because the property market in the UK and London took a bit of a dip in the early 90s. That again is anchoring, and people are doing it now. They're seeing recent stock market performance and thinking, I can just draw a straight line into the future and expect it to continue. So, as an investor, it would be reasonable, given these heady expectations of returns, to expect a dip at some point. The stock market commonly puts in small dips or bigger dips, 10, 20%, not uncommon. Going back far enough, we've seen dips of 50% in the past. But the point is not to worry. This is what I mean about understanding risk. Make sure that you are not forced to liquidate should the market take a bit of a dip, and that's about planning and planning your cash requirements over the short, medium and long term, a topic I've talked about in more detail elsewhere. And it's also really important not to panic when the stock market suddenly kicks back and corrects. And it will do so at some point with the expectations I've just read out. If you like, it's almost inevitable, but sensible, sanguine, long-term investors won't be unduly concerned. They'll know with the correct approach, they can expect to achieve above inflation long-term returns from stocks, and with that in mind, they will not be unduly swayed by investor expectations either on the upside or indeed on the downside. Irrational exuberance may be followed by irrational fear and panicking, but the people who make money from stocks in the long term are not swayed by either. Now, to find out more about some of the topics I mentioned in passing during this video, please do access our comprehensive library at killick.com/learn. And if you'd like a copy of my guides, one of them is on how to invest in equities, then please do ping me an email, editor@killick.com.